And welcome. My name is Muhammad Ali from Mo Realty Team. This is our first video series regarding buying your first home. First step actually begins with personal finance. A lot of folks are excited and want to jump right into looking at properties, but it actually starts in your own personal finance. The first video is actually going to be dedicated towards credit report, credit score, the difference between that, and so on and so forth. Okay, difference between a credit report and a credit score. So the credit report gives you the full breakdown of all of the credit profiles that are open, right? So if you have a credit card, if you have a phone bill, any active lines of credit, student loans, car payments, so on and so forth, is all going to be highlighted in your credit report. Credit score takes all of that, looks at the 5 factors, which we will cover shortly, and gives you a score, right? And the 2 bureaus that you might have heard of are Equifax and TransUnion. Those are the 2 common ones we have here in Canada, and they're going to generate a score and aggregate all of the different credit basically accounts that are in your credit profile, and this will be reviewed by lenders to see what kind of interest rates they can give you, if you even qualify for maybe even A lending or B lending, which we'll talk about after. Let's dive right into it. What are the 5 factors that affect your credit? A lot of folks think they have excellent credit just because they pay their bills on time, which is important, but that is only 35% of what comprises your score. The other 4 aspects that cover that make up your score are credit utilization, your credit history, how long you've had these accounts open for, any inquiries, and public records. So we're going to cover those. We're going to focus majority on utilization, as that alone is 30%. Okay, credit utilization basically is saying for what you have available. So let's use an example. Let's say your credit card is worth $1,000, right? You have a credit limit of $1,000. If you're constantly getting close to maxing out your credit card, let's say you're constantly spending $800 end of the month, you pay it back. Again, you're spending about $800-900, and then you're paying it back. So you're happy, you think you have never maxed out your credit card, and you're paying your bill on time. Actually, what it's doing is actually hurting your credit utilization portion of your score. So your utilization is ideally, you want to keep it at 30 to 40% or lower. So if you find yourself constantly, purchasing items with credit that are reaching $800-900, to do so, asking for a credit increase actually will benefit you in this case. So if you can, manage your finances, I hope when you increase your credit, you're not just spending more, defeating the purpose of this. But increasing your limit to, let's say, $3,000 and only using $800 or $900 will keep it well below the 30% range. And that's one tip that we have here for you. When we talk about credit history, the other segment there, credit history is basically how long you've had the accounts active for. So there always, somebody might have opened up a Walmart credit card or some sort of store credit card, 10 years back, and you don't use it. You find yourself not using it. So what do? You say, okay, no, I'm gonna cut this card, cancel it, and close off these accounts. So if they look at your credit report and they see that all of your credit cards or credit accounts are all very recent, only a year or 2 old, versus someone that has had credit for 15-20 years, that individual will have a more longer history of showing good standing. It'll actually be more beneficial for your score. So we always say, if you have a really old credit card or something that you're not using, keep it active. Don't shut it down, or don't close and cancel it. Keep it running. And what it also does is, if you do get, let's say, a missed payment, somebody that has a 1-year young credit history versus someone that has 10 or 20 years, the impact on what it does to the score is significantly lower, given that you've had a long history of payments. And so credit history is about 15%. Okay? The last 2 are the least important. At this point, each one is just covering about 10%. So I don't want to spend too much time on this, okay? But they are basically the types of credit and new credit. So new credit, let's focus on that. Let's say you go to get a car loan or whatever, they're going to do something called a hard pull on your credit report. So essentially, they're going to review your credit worthiness before they give you, the money, or they're loaning you the money. That does actually affect your credit. I do want to talk about the difference between a hard pull versus what they call a soft pull. Soft pull is, for example, let's say you sign up for Credit Karma or Borrowell. These are free online tools that you can use to basically check your credit report and check your score online. Those create a soft pull. They might at best lower your score by a point or two, and it comes right back up. It's a soft pull. If anything, it might not even affect your score. Don't worry so much about that. A hard pull is when a lender actually goes does a credit file and actually applies for the loan. At that point, you will see a couple of points drop, and it will stay like that for maybe a few months, and it'll go right back up. A hard pull does affect your credit. The types of credit, I'm not too familiar with this one, but they look at all the types of accounts you have. If you have just one mortgage, 2 credit cards, student loan, versus somebody that might have 3 or 4 mortgages, a car loan, student loans, and a bunch of accounts, that might have an impact, as they might be carrying on too much debt, and the way the score is comprised over there will affect about 10%. So that's the types of credit versus new credit are about 10% each. I do want to emphasize here, the focus should be on payment history, which a lot of folks already know, and then the utilization, which is one that is very, very underrated and is almost as impactful as not paying your bills on time. So remember, credit utilization can be simply resolved by just either increasing your credit limits on some of these credit cards or credit accounts, and being obviously frugal and mindful of what you're spending. Okay, thank you. I hope that was useful for you guys, and stay tuned.